Okay, we'll go ahead and get started for real. Just to give a few previews. Thank you, Francis. Good morning to you too. Um, so I mentioned this just a second ago for people who are here early, but I will be streaming a little bit more. I I got to be careful about how much I say, but for the past month, I've been focused on kind of pivoting to something new that I'm getting ready for that we will launch in September. And this stream and things that I'll be doing for the next couple of months, kind of like warm ups and also just kind of getting the word out there about a few things. But I will be streaming a lot more not that long from now. So that also, for one thing, is a call out to all of my friends out there who might be interested in coming on and chatting. I'm trying to get an open door policy going here. So, and also viewers, you can look forward to seeing sort of people from the finance and crypto world more and more on this stream, and which will also be cross-posted to YouTube. But as I mentioned today, we're just going to run through some news real quick, just a few minutes here. And this is all kind of stuff relevant to topics that I cover on the newsletter, obviously. um, One of the, I guess, basically what we're looking at macro right now is everybody is really on edge about the market and the market's response to basically this question of AI spend and AI returns. And we had a report from the Bank for International Settlements, so a really um, serious institution, obviously, warning about overinvestment in the AI sector. Now, I don't think I have the ability to do this right now, but I'm going to put in the chat a in fact, let me see if I can I don't know if I have an ability to put an image in the chat. One of the things that I'm going to be oh, wait, here, let's try this share screen. Um, and if I share this tab, let's see. Oh, it looks like it's working. Amazing. Okay. So, this is not the BIS report, but this is an FT report about the BIS report. This chart that I've got on the screen right here is fascinating and incredible. So, this is the arc of investment rising in a series of technology bubbles or waves or adoption surges or whatever. Now, the comparison here is just staggering. This dark line, I think you can see my pointer here. That's the dot-com boom. So 5 years into the dot-com boom, from a trough before the boom, investment rates had doubled. That's in 5 years. Um, right here, and I think this is the most important one, which we'll talk about a bit more in a second. This is the canal mania of, I think, roughly the 1830s. So before trains came along, everybody thought canals were going to be the form of transportation that linked the United States together, created this huge boom in investment. You can see that 5 years out, it had gone to 4x of the investment rate before the bubble. This is the line for AI. It has already, in 3 years, gone to quadruple the investment that it was before the beginning of the bubble in 2022 or whatever you want to call it. This is significant because, you know, for those of you who know the sort of history of technology investment over the last 10 to 15 years, Peter Thiel and his book Zero to One has really defined how people approach investing. And essentially, Peter Thiel's philosophy is you cram as much money as possible in right up front. You use that to dominate the market, to push out any competitors, et cetera, et cetera. And you've seen that in particular with something like Uber, right? Where they were losing money for a while and then turned it around and were able to turn on their profit spigot, basically. The reason this arc in the AI spending is so significant is because there is actually, in cases like this, no guarantee that if you just cram a bunch of money in up front and build something, you're kind of guessing that there's a market to a certain extent. You're speculating. And in AI, to be clear, I believe there's a real market there, there's a real product. But when you cram this much money in up front, that means you're probably wasting a lot of it. And that waste comes in the form of later collapses in stock prices, later failure of things to actually fulfill the returns that were being promised. The more money you cram in up front, the bigger your returns have to be on the back end. And here's where we get back to the canal boom. This is the curve of canal investing, and you notice it goes up really sharply, and then even compared to these other booms, even compared to the dot-com boom, even compared to railway mania, even compared to the Roaring '20s, the canal boom crashes hard. So you actually see this curve where, and the canal boom admittedly died for a few other reasons, but so does everything. There are competitors. There are other options. In this case, obviously, railroads kind of started becoming an idea by the time the canal mania fell off, but not really. The railroad stuff didn't happen for another 20 years after the 1830s. So, what we're really looking at is just overinvestment followed by a catastrophic collapse. And this is what the AI investors are setting themselves up for. And this is what the Bank for International Settlements report was about. I am going to, let's see if I'll keep sharing this chart for a minute. So the Bank for International Settlements report is really warning about exuberance. Now, meanwhile, in a different, and let's see, maybe there's a chart here that I can share. No, but we do have a different dynamic going on with SpaceX also, and I will stop sharing my screen here. SpaceX is, obviously they did their huge IPO, right? And well, actually, I'm going to do a different thing here. We're going to look at the post IPO performance of the space. Oh boy, it is really, really not looking great. There's a little bit of a bounce back here, but this is the SpaceX chart after their IPO. So we came out, the actual pre-IPO price was 130, IPO offering was 150. It hit the market at 160. Then it ran to 200 in the first week, and then it crashed badly to go all the way down to below the market open price by June 22nd. And then it has been sort of climbing back. And now we're actually a little bit above the open market price. So people who bought the open during the IPO are back in the black. They've made some money. But we saw this big crash. And myself and my research partner, Austin Campbell, really predicted that this would be something that unfolded, and it might still unfold over the next 3 months or so. We might see this little tick up become more of a climb. Maybe, this was just some early exits. Unfortunately, as we've really detailed at Zero In fact, let me see if I can find the chart, the graphic. We have unlocks coming in SpaceX very soon. And so there is a problem because you're going to have people selling it off. Um, and then we'll get to the bond sale. But let me look at the um, unlock timetable that we've got here and share a different chart here. This is the unlock timetable starting in June, which is coming, or actually, we already had some retail flipping, so that might have been the initial sell off. But we have a big unlock coming in August, more in September, October. A ton of unlocks basically on a monthly basis from now until December, when everything is free to trade, with a few exceptions. Um, and so this liquidity unlock, starting from a very small base of only 4% of the equity was sold up front, it's a big problem. And so looking forward, you can see probably some declines coming out. But the new news was that you also had SpaceX selling some bonds, or trying to, and they had some flaccid demand for their bonds, which is debt. So, when you're selling bonds after an IPO, it's quite interesting, right? Because you've already raised a ton of money, you're immediately raising more money, and the signal that that sends is that SpaceX believes the market is going to get soft. And that's a problem, because you obviously you need that demand to be there for those unlocks that are coming up. And what SpaceX is signaling is, we don't think the demand is going to be there, and so we want to get more cash in the door through these bond sales. A week after the IPO, and the bond sales are struggling. Not good. Really, really not good. We're going to run through a few other interesting news items. I kind of have been going slow because those are the most interesting ones. We have an Atom Back linked digital asset treasury company that is trying to SPAC. It's called B BSTR. they're trying to do the master thing. They're trying to basically mimic MicroStrategy, which the timing has not worked out for them now because MicroStrategy is in a crisis right now. They got their SPAC vote pushed back to this coming Thursday. Um, this is a very interesting and complicated story. It involves Cantor Fitzgerald, which is Howard Lutnick's sons control the company. Adam Back was also recently named in the or alluded to in the Epstein emails, according to analysis. And there is also this BIP 110 thing coming up, which is going to be and has continued to be extremely contentious. All of these are mixed together, and it's a bigger topic for another day. But Bitcoin is seeing some real, I would say, cultural issues right now. And this Adam Back DAT SPAC is which is a mouthful, but it is part of that. Back is a crypto OG in many ways. He was part of the Cypherpunk mailing list. But he is now joining in the game with Michael Saylor of doing these DATs. And obviously, he's not the first of the OGs to do what I sort of kind of consider a bit of a sellout and a bad move, but much to watch there. I also want to shout out Jason McCullough at FinTech Business Weekly. I will again share this screen because he has an amazing write-up of this thing called Covered with no E, which is a crypto-backed credit card. I don't know exactly how the crypto fits into it yet, but what really matters is that they're making these weird claims about this being a credit card that can get you 100% cash back. And if you do the math there, that means they're giving you stuff for free. But what they actually have is a very complex reward rates matrix that changes on an hour-to-hour basis. And there are also, incredibly, these gambling features that you can use to use the points that you earn through your cashback, whatever, to get even more cash back. So, or at least theoretically, right? But you actually have to spin and play these games. And Jason describes it as a late stage capitalist fever dream. I think that's pretty spot on. I also think it reaches this extreme where it's complexity, which I've also talked about as kind of part of deception when it comes to things like basic capital, or at least, confusion, maybe not deception, confusion would be the better term. There is confusion built into this rewards program that is designed to make it harder for you to understand what you're actually buying, frankly. Obviously, up front, the idea is they're advertising it as like, oh, it's gamified. You're turning your savings maybe into a game, but like gamification is never good for the person playing the game. Let's just make that clear. Gamification is a way to manipulate your behavior in ways that are less than obvious by making it seem like just a game. Also inside Covered, you have, at least theoretically, which we'll get to, is that this is not a product that's actually launched. But Jason walks through, we have these games we have Texas Hold'em, you can open packs of something, who the hell knows what you're getting here, just like some digital badges, I think. The reality here, though, is that this product isn't actually live. You don't have Covered is not offering its cards yet, but it's very close apparently. And so good on Jason for flagging this before it's actually live, because you have, just this really crazy embodiment of, yes, Francis, gambling exactly baked into. We heard you like gambling, so we put gambling into your credit card points rewards program, which is just, you can say a lot of things. There's a lot of opinion to be had about it. But unfortunately, it does represent the direction that our economy is going. Buttercup, you want to come over and say hi? We have another cat, by the way, who is generally not that social, but oh my God, here she comes. Maybe we've got a treat here. Come here. Come here. Come here, little baby. Yeah. Hey, come here. This is Steve's sister, Buttercup, who will not like being shown on the stream, but she'll hang out for 2 seconds so I can just... Yeah, she's not happy about it. Anyway, that's the cat news for the day. So next, we had Binance denied approval under the MiCA regulatory framework in Europe. This is interesting. They're saying they're going to, circle back around and try it. But one of, Austin and I were talking about it yesterday. And what's interesting here is that Binance has kind of tried to straddle regulated and unregulated. And the US has allowed them to get away with it. Famously, you look back on something like the Tai Chi document that was uncovered a few years ago, where they sort of intentionally do not have a headquarters. And that's in part for the reason of regulatory arbitrage, and they spelled it out fairly clearly in this document. So now you have them running up, it seems, against people who are just not willing to let them play that game. I mean, is one way to read into the denial that your regulatory status is not clear enough for us to actually issue a judgment that is meaningful and helpful. So that I think could wind up being a big deal for Binance. Obviously, they are the biggest crypto exchange, and that is a huge part of their appeal. That they have the most liquidity, the best trading options. But if they start losing territories, and if Europe says no, others will take a hard look. That's one thing you can think of here, is that this is kind of a domino that can fall. And an entity like Japan, China. Well, China already is its own thing, but Japan, South America, you might have these other regimes and regulatory regimes that are looking harder after this happens once. Once you get one denial, you can start losing it. We also have a lawsuit by the CME, the Chicago Mercantile Exchange, trying to stop the CFTC from approving Kalshi to offer perpetual futures, and also and it's sort of through this dispute over the distinction between futures and swaps. CME is claiming that perps are swaps, not futures. That gets really into the weeds, and frankly, I don't understand the entire distinction there. It's going to be a project to try and figure that out. But the CME is a big deal, and for them to be suing their TradFi regulator is a big deal, even though there's basically no rules under the Trump administration. This will have long-term impacts because this suit will play out over, hopefully it will be allowed to play out over a couple of years, maybe. And some people are comparing Kalshi and especially Polymarket now to Juul and the vaping companies that basically were making a ton of money for a little while and then had a real crash down in terms of their ability to sell this stuff, because the regulators came in and said, well, you're marketing to kids. That's no good. Polymarket also recently got hit with this Wall Street Journal investigation into claims that they were making ads that were essentially fraudulent, that sort of represented all of these winnings as happening that weren't actually winnings. They were fake. And so people have been saying that there is kind of a jewel moment coming for these prediction markets, and I think there's something accurate there. I think there is very much the possibility, even given the current extremely permissive regulatory environment, that maybe not during the Trump administration, but not too long from now either, there comes a kind of regulatory reckoning. And I think that is something that investors, especially as these platforms inevitably start thinking about an IPO, important for investors to keep in mind. I'm just looking at a note here. Oh, wow. Okay, interesting. The the vaping products, I guess, are back on the market. I was not aware of that, but yeah. So speaking to the current regulatory environment, you can kind of do whatever you want, but that doesn't necessarily last forever, and you don't want to depend on that long term for what you think is going to happen with these platforms. Um, so I want to talk through, and this is going to be very brief because I do not know this intimately. But we have a new Supreme Court decision. In fact, two kind of separate Supreme Court decisions that happened in different ways. So on the one hand, we have the Supreme Court saying that Donald Trump can fire Lisa. I'm sorry, not Lisa Cook. I cannot remember who the FTC person was who was fired, but the Federal Trade Commission, Trump fired somebody recently, and the SCOTUS basically said, yes, this is okay. And this is part of this kind of unitary executive view of kind of the regulatory universe, where the FTC, under this theory, basically belongs to the president. These are all executive branch agencies, but we had until very recently this standard known as Chevron deference, which was allow the agencies to sort of independently define the rules based on Congress legislating directional guidance for regulation, that has now been ended. So you now have the ability for cases to go in and really look at whether regulatory rules align very specifically with rules laid out in Congress. And if they don't, well, they might not be valid. Now we have unitary executive theory going in and saying that not only are these rules subject to challenge on a line by line basis by Congress, but okay, we got somebody with a summary in there, I guess. But also now we have this idea that the president can fire anybody he doesn't like from any regulatory agency. Now, the reason this gets interesting is that they then also issued a completely different decision on the case of Lisa Cook, one of the governors of the Fed. Trump has tried to fire her, and the Supreme Court came in and said, well, we said it's okay, you can fire the head of any regulatory agency. The Fed, in theory, is also part of the executive. But basically, Roberts comes in and says, well, there are specific provisions that the Fed has to be independent. And so we're going to respect those and say that it's different from these regulatory agencies. So you actually can't fire Lisa Cook. Now, you can talk about the sort of legal rationale for all of this, but the truth is that you can't fire the Fed chairman or governors because it would create total chaos. It would collapse faith in the Fed if the president, especially this president, had the right to go in and fire people. It's already, frankly, scary enough that he named a chair who has different ideas about money than basically any Fed chair we've ever had, and can't necessarily, in my very preliminary opinion, might be a little bit dicey in terms of managing the money supply. But if you had the ability for the president to go in and fire people, faith in the Fed would just collapse. Inflation worries would get out of hand. And basically, just on a practical basis, the Supreme Court cannot allow the president to be firing people. So they've figured out a way to split that apple and say you can fire people from regulatory agencies. You can't fire anybody from the Fed, Donald Trump. And so we will, again, see how that plays out. But in the short term, it's good because obviously having Trump firing people from the Fed would have been total chaos and would have completely fucked financial markets. Pardon me. But in the medium term, it's really debatable what the impact of that was going to be, because now you have regulatory chaos, which we'll see. Let's see. I'm just looking at Francis's comment. Yeah, so there is, there is Supreme Court precedent for protections for the heads of agencies and regulatory bodies. But we're living in a new era. I'm going to say we're about ready to wrap up. Very quick heads up. I don't know if anybody has questions in the chat or anything you'd like to hear me talk about that I haven't. I will be trying to make these more, interactive, including more people. Obviously, not a ton of folks in the middle of the day, but we will obviously be sharing clips and I'll be figuring out times when this is most useful for people. But I hope it was a good, useful news roundup. Again, we will be doing this more regularly. I will be doing this in an increasingly formal way, so it won't necessarily just be me sitting in my office for all that much longer, just as a little tease. Make sure to also follow the YouTube channel. I will be streaming, hopefully getting set up to stream both to Substack and YouTube simultaneously very soon. So keep an eye out there. And if you missed any of this, the stream will go up fairly soon. I don't put it up immediately, but keep an eye out. And clips will start going out really soon too. So thanks to everybody. Extremely big thank you to Francis for contributing. Hi, Noelle. Everybody who sees Noelle in the chat, go and listen to her stream, follow her newsletter. She's also commenting on sort of the TradFi new tech intersection. Pardon me, I'm making a crazy face while I'm experiencing indigestion. All right, what a note to end on. I keep it informal here. So thanks, everybody. Stay tuned. Keep an eye out for future streams, and we'll keep doing this. 27 minutes, pretty good. That's the goal. All right, take care.